mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates, welcome everybody, episode 11. Happy to be with you here with my equity mates buddy Ren. How are you, mate?
I'm good, mate. How are you?
Good. We've had a pretty interesting week with some of our stocks in our hypothetical portfolio, which we'll quickly run over before we kick off proceedings. But as always, the show today is going to include some news for you guys. There's been a lot happening. And then Ren is going to go into a segment on investing versus speculating and what are the differences and what it means to us. And then, of course, we'll jump into a stock of the week. So big show coming up, and we're pretty pumped to get into it. But to start off, a quick update on our Equity Mates hypothetical portfolio, which you can check out on our website. We're doing pretty well. We're happy with where we're at, but there's been a few developments in some of the stocks that we've picked this week. So, Ren, you want to take it away?
Yeah, absolutely. So one of the first stocks we picked was Australian Agricultural Company. Now, as the name suggests, they're a big agricultural company. They produce a lot of beef, and they've recently got heavily into the beef export market. So India's the second largest beef exporter in the world, and they account for 20% of all beef exported. Now, it's really important for Australia, this ban, because would you believe it? Indian buffalo meat was becoming a serious competitor to Australian beef exports.
I would not believe that.
It's particularly in Indonesia, where there's a lot of value put on just a cheap source of protein, and obviously Indonesia being so close to Australia, it's a big market for Australian beef exports. But yeah, Indian buffalo meat was really cutting into Australian Agricultural Company and other beef exporters' profits. So, we wait and see whether this ban will be upheld. There's a lot of money at stake for Indian farmers, so could be overturned. But at this stage, it's good news for AAC. It's bad news for people who like buying beef, because the global beef price should rise.
Hopefully we can see a bit of a price movement over time for AAC. We bought them at $1.68 and they're now sitting at $1.87, so about 11% up. So pretty happy with that one. And then the other update we have is with AFY or Afterpay. We bought them last episode, I think it was, and their news was that they have just signed an exclusive partnership with Trade Me, which is New Zealand's largest online marketplace. And they have a very strong brand over there. So this is a great way for AFY to get a channel into New Zealand and expand on their markets and offerings. So that was great news, and the market responded pretty well to that news. Over the last week, Afterpay has jumped by about 15%. So it's now sitting at a healthy $3. So pretty happy with both of those. And it's always so far. Also worth mentioning, guys, that we are going to be changing our broker from what we were previously with, who was it, Ren? CMC Markets.
Yeah, that's it, yeah.
Yeah, so they were doing $11.95, who at the time when we signed up with them were one of the cheapest brokers in the market.
They still are one of the cheapest, but we're going to the very cheapest, which is IG. Now, they charge $8 for brokerage, and if any listeners out there want to call me out and point out a cheaper company with cheaper brokerage, let us know, because we'll move to the cheaper ones still.
We'll jump ship. But there's absolutely no reason that you should be paying, I know CBA, Commonwealth do $19.95, which at the moment just seems a ridiculous price when you can be paying $8 per transaction. So we've changed to IG, and that will be reflected in our portfolio online as well. Yeah. So just thought we'd update you on that.
It's worth saying as well, in real life, I also have changed from CommSec to IG. CommSec was really convenient for me because I'm a CommBank customer, but you save $11 every trade. It's not a lot, but it's something.
It's certainly considerable when you might be trading in the minimum $500 allotments as well. And as the same as you, Ren, I've also changed to IG. I still have holdings in Commonwealth, but my new trades will be done through IG.
Yeah,
and
we should say IG haven't sponsored this segment, but if they want to sponsor us going forward, we'll keep giving them a plug.
And they also do international trades for a flat 10 US, so that's also pretty appealing. If once you get to that stage, it's worth having a look at. Anyway, so moving on. There's been some big news agendas this week. Ren, you want to take it away?
Yeah, sure. So the big news on everyone's lips this week is that Trump has left.
I don't know about everyone's lips.
Oh, I don't know. It's been pretty widely discussed. For those who haven't heard, I guess, then President Trump recently pulled out of the Paris Climate Change Agreement, an agreement that every nation on Earth, aside from Syria and Nicaragua, signed. And would you believe it? Nicaragua didn't sign it because they didn't think the agreement went far enough. So really, it's now only Syria and America that are pulling out of the climate agreement. In my opinion, not a lot of investment-worthy news. You know, people will jump, to hot takes like, oh, clean energy stocks should fall, and, this is great news for oil companies, and, oil stocks did rise on the news. And there is some truth to that, but in the long term, what we're seeing is that the market for clean power is really driving action more so than government policy. Even if America pulls out of this agreement, I think, the incentive structures globally are still there. We see China investing huge amounts in renewables. We see the Europeans forging ahead. India's announced a huge commitment to continue investing in renewables. So, if you own a clean energy stock, I wouldn't fret too much. I think the incentives are still there. On the inverse, the long and slow decline of fossil fuel industries may have been halted, but it probably will still continue over the longer term. So I don't know. I don't reckon there's too much there.
Yeah, no major ramifications at the moment, but I guess it's just interesting as well that Trump's just going on his own agenda, which no one can really predict where it's going, and that in itself can create some volatile activity on the market. So
yeah, if you think you know what he's thinking, pull out of the market. You don't know what he's thinking. No one knows what he's thinking.
Or bet a lot of money and you.
I mean, Steve Bannon doesn't know what he's thinking.
Yeah, God.
I don't think he knows what he's thinking.
No.
Anyway, let's move on to something that we
is it at least stocks related. So start of last week, I think it was, big news across the front of the Australian Financial Review, May 30th, for those that are interested. Philip Parker, who was the Chief Investment Officer and I'm pretty sure founder of Altair Asset Management, sold everything that they had under management and returned all of the cash back to his investors. He put it down to the fact that he was predicting big doom and gloom in the markets to come, asset crash and all sorts of things, that he was putting it down to the fact that his reputation was on the line. And by doing so, he was selling out all the profits that he had made over the last few years and returning all of the profits back to his investors, who were all happy with what he'd been doing, because he foresaw that down the track, the markets are going to turn and he might not be in a position to be able to protect that money as well as if he hadn't have made this decision. However, I'm not sure where you stand on this, Ren, but there was definitely a lot of commentary about, is there more to this? It's a very unusual thing for an asset manager to come out and just completely liquidate and sell all, because at the end of the day, half of their role and the reason that they're paid all of these management fees is to actually protect your money in economic cycles. So selling out seems like a bit of a cop-out, really.
Yeah, and if I can be really cynical for a moment, even when these funds perform really poorly in the event of a crash, these fund managers make performance fees, but they also make fees for just assets under management. Yeah. So this guy either really had to care about his reputation so much that, he was willing to forgo a lot of, personal wealth, the furtherance of his career. It is a big move. It's not as simple as just giving everyone their money back and then, 6 months later giving them a call and, putting the band back together, so to speak.
Yeah, exactly.
It's a career-altering decision from him.
Yeah, in a big way. But firstly, I think we should start with, we'll keep this brief, but, he started with this whole doom and gloom outlook, and that's something that we've been talking about over the last few months as well. There's a bit more chatter coming through, and investors are starting to make decisions about putting more in cash and that sort of stuff. So in terms of overall market thinking, he's sort of preaching the same sort of message. So that is one thing to consider. The second side is having a look behind all the fanfare and at what is actually going on. So do you have anything to add to that, Ren?
Well, yeah, I mean, it's come out that he is being sued by his mum in the New South Wales Supreme Court. Apparently he used his mum's shares as collateral on a loan. she's alleging that it happened without her permission. I mean, we don't know. One might have everything to do with the other. It might also have absolutely nothing to do with the other. He the funds were going okay. His two funds were ranked 19th and 21st best equity funds in Australia by Morningstar.
Okay.
But so on the surface that looks good, but he had two directors resign, one in October last year and one in April this year. So I mean, look, there's a lot of facts going on in this story. To be honest, I don't know if this story itself is too interesting. I think I don't know if it's too important. It's an interesting story, but at the end of the day, you either agree with his prediction, you think the market's fully valued, you think there's a property bubble, and you agree with his decision to move to cash, or you think the market's still got further to go, and you might think, you might justify it and say there's more to the story. Yeah. Really, the more important thing here is what the market's doing rather than what this bloke's doing.
Yeah. Good point. So that brings us to today being the first Tuesday of every month. And that's the time at which the RBA have their meeting and discuss what they're going to do with our interest rates. So interestingly, over the last few months, there's been a lot of talk that, the interest rates are going to stay as is. We're going to float through to the end of the year, and 2018 will come, and then the RBA will probably decide on what to do going forward. However, recently there's been a lot more talk and pricing into the market that the RBA, if not today, then in the near future, will be actually cutting interest rates.
And if the RBA is cutting interest rates, what does that mean more generally?
So a cut in interest rates generally means that they are trying to stimulate the economy. They're seeing that they're trying to make access to money cheaper so that businesses will invest more, consumers may borrow more and spend more. And essentially, it's a way that the central banks use to try and encourage economic growth. So that obviously gives an indication that if they're willing to do that, then obviously Australia's economy is probably not going as well as they had been thinking. Now we're going to be getting some gross domestic product or GDP results coming out tomorrow for Australia, which are said to be quite weak and weaker than expected. Now the RBA said today that over the next 3 years, we're going to be hopefully growing at around 3%. But a lot of people are saying that's a very ambitious target. So at the end of it all, the RBA didn't do anything with rates today. They decided to sit on it. But what was more important was the message that they gave across. And unlike the last few months where they have come out and said, used quite strong words in terms of growth rate, housing prices, et cetera, the statement that they released today was a little softer than usual and left them with a bit more wiggle room in case things did start to turn a bit bad or worse than expected. So watch this space, I guess, because an interest rate cut for Australia, in my opinion, is probably not the best thing going forward. But unfortunately, in this economic climate, and it's something that we haven't seen in a long time, the ability for the RBA to actually change the way we're going forward is quite tied. Their hands are tied at the moment. Moving interest rates even lower will only further inflate house prices and probably not stimulate demand just the way they want it. So
the other really interesting thing to take into account is Australia for a while has had a two-speed economy. So for a while there, when the mining boom was really kicking along, WA and Queensland were crushing it and the rest of Australia, not so much. And then since the mining boom's really slowed down, we've seen, especially New South Wales and Victoria, really pick it up, and a lot of the other states start to lag behind. So it's really difficult for the RBA to make these decisions because, if you're going on a state-by-state basis, interest rate decisions might be a little bit easier, but you've got to make policy for all of the country, and lowering interest rates might stimulate economic growth in WA and some other states, but then it might also further inflate a property bubble in Sydney and Melbourne. Yeah. So there's always two sides to it for the RBA. So I guess we'll wait with bated breath.
Yeah, definitely. I think the main takeaway from that though is that their outlook on the Australian economy seems to be changing as is the market. So and not for the better. So see what happens.
Yeah. Well, after all that doom and gloom, it might be worth I mean, this story isn't too. It's not quite fun, but it's an interesting one.
Yeah.
So everyone loves a good technology company. Everyone wants to be the next tech billionaire. If you had invested in Amazon or Google, which turned itself into Alphabet, you would be well on your way to being that tech billionaire. Both of their stocks have just hit over $1,000 per share.
US or Australian?
US.
Wow.
Yeah. So they've been on a pretty incredible ride. A lot of people talk about the tech boom of the 90s that crashed in 2001. Well, I mean, Amazon and Google's share price now compared to then is nothing. They're crushing what they were in 2001.
Yeah.
And that is even with a big correction when the market crashed. So there's lessons to be taken away, but also Amazon and Google are quite unique as companies. But I think, a lot of people when the market crashed in 2001 would have thought, screw tech, it's a fad, it's done. But even in the worst of crashes, there's people who buy and hold, and 15 years later they've come out on top. It's probably a good lesson for all of us.
Well, they're now some of the biggest companies in the world, so they've definitely got something going for them.
Yeah.
Also, just to point out that in cases like this, and it happened to Facebook, once they get to a price like this, there's the option to split the shares so that rather than being $1,000 and continuing up, they will split the shares and create more so that the price is reduced to make it more accessible for retail investors like yourself and I. So, for example, if you held one share of Amazon for $1,000 and they decide to split it 4 ways, that means you'll then hold 4 shares at $250 each, and they will now be $250 on the market. So you could then go and buy them for that amount rather than someone having to have 1,000. They can buy one for 250. Not everyone will do that.
The most famous example of not doing that is Berkshire Hathaway, which is now trading for something like 250 grand per share.
Yeah. Unbelievable.
So if you bought that when it was a few dollars a share, you're laughing.
You are cheering. Yeah. Well, look, who knows? Amazon and Alphabet might not decide to do it, and we could be sitting here talking about how $1,000, wow, one share, but who knows? In 20 or 30 years, 50 years, Amazon might also be $300,000. So. Yeah, keep Berkshire in mind when you're thinking about looking at Amazon. Oh, $1,000, it's too expensive. It's too expensive. It could be worth a lot more.
Yeah.
All right, well, that's it for the news. Some good stuff in there. So to move on, we're going to bring in a bit of a book review segment here. Ren's been reading a book that we discussed in, I think, episode 5 or 6 when we were talking to Andrew Brown. He suggested a book that, how much is it now online?
If you want to buy a new copy off Amazon, it's about $1,500.
There you go.
So almost the price of one Amazon share.
Yeah. So Ren was lucky enough to come across a version that wasn't as expensive, and you've been reading it over the last couple of weeks. So take it away, Ren. What do you got?
Yeah, so I guess the best place to start is who wrote this book? Who writes a book that is worth $1,500? So the investor's name is Seth Klarman.
Okay.
And he is very highly respected in the investment world. So much so that he's been nicknamed the Oracle of Boston, which is an homage to Warren Buffett's Oracle of Omaha.
Okay, yeah.
So he has a very similar philosophy to Buffett. Value investing. Find companies that are undervalued and buy a lot of it, and wait for that value to be realized by the broader market.
Okay.
The story goes that Warren Buffett keeps a copy of Margin of Safety on his bookshelf. So that's
the name of the book.
It's called the book's called Margin of Safety. Probably should have introduced that at the beginning. And just to give you an idea of what Klarman's done as an investor, he is the head of a investment company called Boarpost. Probably butchered that pronunciation, but Boarpost Group. He's only lost money 3 out of the 34 years that he's been in business, and has seen 20% compounding annual rate of return.
What?
So essentially, he's making 20% a year every year for the last 34 years.
That is actually Buffett's sort of
it's unbelievable.
league.
Well, this could be wrong, but I think it's almost at Buffett. It may even be better than Buffett.
Wow.
No, excluding Buffett's crazy early years.
Yeah.
And you know what? I'm not talking out of any figures here, but yeah, look,
That's
it's
fine.
bloody close. It's bloody impressive.
Wow.
So yeah, now Klarman wrote this book in 1991, and they originally sold for only $25. But they stopped printing them. I think it didn't do too well to start with, but then it got a cult following, so that's why they're so expensive now. I was lucky enough to get my hands on a copy, and I've pulled out 3 things that I reckon everyone can take away from, but it's definitely worth calling your local library and seeing if they've got a spare copy. Because
or call Ren, you can rent yours out.
I could, yeah.
Interesting. We'll put up our prices on the website.
Shoot us an email, equitymates@gmail.com. We'll negotiate.
So just to confirm, just to reiterate, it's Margin of Safety by Seth Klarman.
Yeah,
is that
spelled Klarman.
Cool.
Yeah.
All right. So what are the three takeaways?
So the first one is something he calls the institutional performance derby, and it's a common critique of Wall Street these days, but it's something that everyone should just keep in mind when they're thinking about who they're choosing to manage their money. Even if you don't have a lot of spare cash that you have being managed, everyone's got a super fund. This is something that everyone should think about because most people don't think about it. And he talks about for Wall Street, the incentive structures is all wrong.
Mm-hmm.
All these big institutions, all these big banks, all these big investment banks, they make money on activity and transactions in the market. Companies make money on brokerage, on underwriting new securities. They make commission on convincing investors to purchase certain investments. And this is all done regardless of the outcome on these activities. And then for investment funds or superannuation funds, money is made as a percentage of money under management rather than the performance in a lot of cases. So that
seems like a bit of a rip-off.
Yeah, it is. But it just means the incentive for these, superannuation funds or these big investment funds is to get more people into the fund rather than to manage the money in the fund really, really well.
Yeah.
And a lot of the time there's performance fees as well. So if they kill it, they'll also get a percentage of that. But the main consistent money is made from management. And then he also talks, so combine all that with the hyper short-term focus of a lot of Wall Street people and Wall Street firms. So, because Wall Street and, by extension, all investing markets really is just so hyper competitive, it's really hard to have a long-term focus.
Yeah.
It's really hard to tell your investors that, 5 to 10 years down the line we'll be doing okay, but you've just got to sort of hold out now. A great example, not in this book, is Warren Buffett during the 80s, the high-flying years of the 80s when everyone was making a buck and everyone was killing the market. Warren Buffett's, slow, patient value investment approach was pretty ridiculed at the time. Well, at least he was, criticized for leaving money on the table. But come the crash of 87 and come the market correction, people started to see the value in what Buffett was doing. So look, this is essentially what Klarman's writing about. And the big thing that I took away from it is that, even if someone professes to be an expert and professes to be acting in your best interest, you've always got to look at the incentives underlying that.
Yeah.
Is it just a super fund who's looking to get more money into their fund so they can take more fees? Or, is this person trying to sell you based on, their last 6 months performance of their fund rather than the last 6 years? And he's pretty scathing about what he calls the institutional performance derby. It's a good read. It challenges a lot of preconceived notions I had about, the expertise of Wall Street or, investors.
It sounds like almost like a big sales pitch from some of them.
Well, it is, yeah. And ironically enough, this book maybe was a sales pitch to put money in his fund. But no, I think he makes some good points.
Yeah.
The good thing that he doesn't get too stuck in the detail of, sort of like technical analysis or terminology. Like he just lays it out really clearly and really simplistically, like how the incentives are structured and how that is a problem for some people. So definitely something to think about and always something to keep in mind when you're choosing, what super fund or, what financial advisor you're gonna take on.
Yeah, nice. Because at the end of the day, fees year on year add up to quite a substantial amount of your portfolio that has to be paid out to someone else. So
yeah. Definitely.
Good point.
Yeah. So the next thing that he wrote about that's worth keeping in mind is investment fads.
Okay.
Now, investment fads for Klarman, writing in 91, were things like leveraged buyouts and risk arbitrage. Now, you don't really need to know what these fads were, but, they were big in the 80s. They made a lot of people a lot of money.
Yeah.
But then, the fad ended and people lost a lot of money, obviously.
Yeah, all came crashing down.
You can see fads today. The big one at the moment is the the pot stock fad. Everyone wants to own the next billion-dollar marijuana company, and look,
Sounds familiar.
yeah, and some people will make money on that.
Yeah.
It was the same in the 90s, the tech boom. Like,
Mm-hmm.
there are investment fads, and Klarman, he really explains sort of how the fad develops, and it's something that
FOMO?
oh yeah, basically
Fear of missing out.
It is because early days there are a few investors that are in this particular industry and they start making a killing. Tech investors in the early 90s, corporate raiders in the 80s, people who invested in pot stocks in the early days recently, and then everyone gets FOMO. You're right, and a flood of other investors jump into that market, and what that does is it bids up the price that investors have to pay to get into that market. So because there's so much more demand, it gets harder and harder to get into that market. But then what also happens is that investors' appetite for risk changes. So you go, the tech boom is a perfect example. You go from the pretty safe, pretty solid tech companies that were making a profit and were a solid business as well as being technology companies. But as the hysteria grows, the risk profile, that you're willing to accept increases. And you start investing in companies, with no profit, no users, no way to make money, but they've got .com in their name, so people are willing to take a punt. But then what happens is at some point people get cluey to the fad, and everyone starts pulling their money out, and then you have a massive correction as panicked investors all try and pull their money out as quickly as they can.
Yeah,
and
it's interesting. So, does he discuss how to manage this feeling? Because it's definitely a feeling that, I've been through, and I know a lot of our mates and other investors go through, is that you see these stocks soaring and you think that you should get on board and it's all going to be roses, and then all of a sudden you throw it in and you lose out. So does he make mention of what's the best strategy when this sort of stuff happens?
Yeah, definitely. So the important thing for Klarman is that he's a value investor in the truest sense of the word. And so what that means is every company he looks at, he tries to determine what their value would be. If you took the business as a whole, what its value would be, and then you look at its share price, and you try and determine if you're getting a bargain, and you're just trying to find value stocks, regardless of what regardless of what industry they're in, regardless of what they do. You're just trying to find bargains out in the share market. And so, it doesn't matter whether where the crowd's going. Like if you're looking at a technology company in the middle of the 90s and it's got good cash flow and you can get it for a bargain, then don't let the fad scare you away. But at the same time, if you're looking at a company that has no cash flow, doesn't have a profit, doesn't have users, is just selling a dream really, then obviously avoid it. And don't try and make money on the fad. So don't try and pick where the crowd's going and ride that wave and then time your exit before the market crashes. Because
you're literally just gambling now.
You're guessing. You're making a bet on your ability to read human psychology more than you are business fundamentals.
That's where a lot of people come unstuck.
You can sort of see fads everywhere these days. And
Bitcoin.
Exactly. Bitcoin. And the thing is, with every fad, there's always a kernel of truth underlying that fad.
Of course.
But the important thing is just recognizing when even if it's true that in 20 years from now there will be like established marijuana companies that make a lot of money and will be very good to investors. You have to be pretty confident in your ability to pick the right company and be able to do the fundamental analysis to find the value stock and buy it, because it's a young market, there's a lot of hype, and you don't know if the company you pick will be the right one. So, and I guess
I like that point. It's a good one.
Yeah. I mean, it's a good book, I'm telling you.
Well, $1,500.
You'd hope you learned something. So I guess this takes us to the last lesson, and this lesson was my favorite one because it is very simple in its essence, but I reckon it's quite profound.
Okay.
And it's best summed up with a question. Are you investing or are you speculating?
Nice.
Now, you're buying shares. You're investing, right?
Yeah.
Yeah, well...
Are you?
I don't know.
I know people who buy shares, and I would say it's speculating. So.
Yeah. Well, so I guess it's probably, to preface it, it's probably worth talking about. Investing versus speculating, it's not a new question from Klarman. It's something that is kind of constantly debated by investors. What's a investment? What's, a speculation? I mean, there are examples where people say it's, if you're buying a company before it's earning any revenue, that's what you define as speculating. Whereas if a company has revenue, it's investing.
Yeah.
I mean, there are others. Some people say it's about time. Like if you're only buying it for like, a day or a week, then you're speculating on the price movement. If you're buying for the long term, then it's investing.
Some people even look at it in terms of the price of the stock. Like if it's only under 50 cents, then you're making a speculative investment. If it's over $1, then you're investing.
Yeah, like there's
risk level as well.
Yeah.
Are you taking on a high risk? Then you might be more speculative. Whereas a stock that you think has a very low risk, then you might be inclined to say that you're investing. So
look, there are lots of definitions, and I'd heard different ones, and I had an idea about what was investing or speculating. But I've got to say that reading this book, I reckon Klarman makes a very strong point for his, I guess, conception of what is speculating and what is investing.
What is it?
And he makes the key distinction. So when you invest, you are expecting to benefit from the free cash flow generated from the underlying business. So what does that mean? That means that when you buy a share and you're investing, you're expecting either the company to make money and for you to make money from dividends, so for you to earn off that investment, or for the company to make money and to grow its business operations. The underlying engine, the actual business that you're investing in grows, and it gets more customers and more stores or more locations or more users or whatever it is, and it actually grows. And then the share price only rises because of that, because of the increased business activity that the company's seeing. So when you're investing, what you're doing is you're investing in the revenue making ability of the business to continue engine to make profit. And he compares that to speculating, where what you're doing is you're buying a share or an asset or anything else with the expectation to make money because others are willing to pay more for it in the future. So what you're doing there is you're saying, I am buying this share because I think the share price will go up in, X amount of time.
Just because others are buying it.
Yeah. And, there's some great examples outside the investing world, like people who are investing in art, they don't invest in art because like the underlying business of the painting
because the art's growing on the wall.
Or there's any way that painting itself
changes
is going
over
to generate
time.
you money. But people are investing in it because they have the expectation that someone else will pay more for it at a later date. It's the same with there are some property investors who just buy property because they expect it to go up in value at a later date, and there you're speculating on the price. But that can be compared to people who are investing in property, and what that means is they're buying the property and they expect to make an economic return from rental income every year. And in that way, you're expecting to generate free cash flow, i.e. rental income from the investment that you made in the property. So, it's not just like some asset classes are investing and some asset classes are speculation. But I think it does lead to a very powerful conclusion, which is that anytime you're thinking about putting your money in something, an investment, or, you're expecting to make money from something, always think, why do I expect to make money from it? Do I expect to make money from it just because I think that somewhere down the line, someone else is going to pay more for it? Or am I putting my money into it because I expect, the money that is generated from that, from the business earning revenue, or from the property earning income, or, whatever it is, it just earning money, and that is going to make me money. Essentially ask yourself, do you have to sell it to make money?
Two things that come to mind. Firstly, for me, it's sort of the way I look at that is, one, you're buying it, as you said, into the actual business and the way that it generates money. The other way, you're essentially just betting that, or gambling with yourself that, the price is going to change, and that's how you'll be making your profit. But what came to mind when you were explaining that was, Buffett, one of the famous things Buffett says is that, he wouldn't care if the market's shut down for 10 years because he knows that the businesses that he's bought will all be generating cash flow regardless of if people are buying their stocks or not. and he'll still make income from that cash flow, regardless of if the price of the stock rises or falls. Whereas if you're a speculative investor and you put your money into a speculative stock, expecting that you would be making money because someone else bought, and the market's shut down, then you're not going to be making any money at all, because there's no one going to be there to able to actually purchase the stocks off you. So that's a sort of good example of Buffett backing up what he's saying.
Definitely. So, yeah, like, I mean, there's a reason that, you know, Buffett and Klarman and all these guys have sort of had such long careers, I guess. Klarman, 34 years, a lot of success. Buffett, you know, I guess
longer.
Close to 60 years almost.
A lifetime.
Yeah. And the important thing is that, you know, when you're investing, when you're putting your money into something, don't put it into it with the expectation that, you know, you'll find someone else. You know, in finance they call it the greater fool. You know, if you buy something, you've got to find a greater fool to purchase it off you at a higher price, and that's how you make money. Instead, you know, buy business because it's a good business, because it will make money for you 10 years, 20 years down the line. Yeah. So I mean, look, it's obviously easier said than done. If everyone had that ability to just know that, you know, a business is going to keep generating profit, keep growing, keep paying you good dividends, you know, a lot more people.
It is easier said than done, but I personally take comfort in thinking about it that way. For me, for some reason, it takes away a lot of stress, rather than going in a bit blind and thinking, I'm just going to put some money on this bit and hope that, you know, that it goes up, or as you were talking about this FOMO thing, you know, jumping in and hoping that it's going to go up over 3 or 4 months. You can take some comfort in sitting down and actually looking at the business, taking away the price and looking at it as a business. And if you can become confident in your own judgment over time that, yes, despite the market fluctuations, this business will continue generating revenue over time.
Yeah.
So, yeah.
Yeah, nice.
I like it.
Yeah.
Did you end up doing a review on that we can put up on the website for the guys?
Yeah, so I've done a little write-up. I've included all 3 of those lessons, so give it a read.
We'll put that up live when the episode goes live, and we'll also put up your rental prices for the book if anyone wants to get their hands on it.
Yeah. So, you know, I'm taking all offers, and, you know, if someone
Keeping in mind, minimum price is $1,500.
Yeah. If someone wants to buy it off me as well, you know, like, we'll talk about it. Now, that's an investment, because, you know, the book might not make you money, but the knowledge inside it, you know, will generate money for you for years to come.
Well, you've just told us 3 points, and so you've given us about $700 worth of value already.
Yeah. So all checks can be sent to Equity Mates, or you can direct deposit straight to our bank account.
Exactly. Yeah. Awesome. So, no, that was good. First little book review. Well, it was quite a lengthy one, but I think those lessons were great and encompass exactly what our overall sort of message is, especially the way both you and I are trying to invest. Okay, so moving on, stock of the week. We'll keep this one brief because there's not a lot to discuss about it, but it's an interesting concept that we came across during the week and that we thought we'd share with you guys. It's sort of in line with what we were discussing earlier about this whole doom and gloom and people thinking that the market is going to be turning, and what does that mean in terms of constructing a portfolio, and what are some ways in which you can set up your portfolio so that it has a defensive element, so that if the market does turn, you've got some stocks in there that either won't crash as hard or will actually make you some money. Now, I know that sounds a bit weird. How can stocks make money when the whole market is going down? But it's all to do with shorting the market, which is a concept that we'll discuss later on. But this week's stock of the week is called BEAR, B-E-A-R. Yes, it's not the traditional 3 letters that the ASX usually follows, but that's because this is an ETF that is negatively correlated to the market. And what that essentially means is that if the S&P ASX 200 goes up, then the value of BEAR is going to go down, and vice versa.
Yeah,
so
it's meant to be correlated pretty closely. So it means if the ASX goes up 1%, BEAR goes down 1%, and vice versa. So you're betting on the market going down.
So with that in mind, then it makes sense that you wouldn't be purchasing this stock if you have And, if you think that the market over a period of time is going to be going up, you wouldn't solely have a lot of cash in this because it's negatively correlated and it would continue to lose value. However, it's something that is worth having in the market in your portfolio when, we have been talking about, as I said, the doom and gloom, that sort of stuff, so that when markets do turn, you will make a bit of money from at least this stock. So to give you an example that it does actually do what it's supposed to, let's just look at May. At the start of May, the S&P 200, ASX 200 was at about 5,900 points. And at the end of May, it was at about 5,720 points or thereabouts. So it fell by just under 5%. And Bear went up just over 4% or about 18 cents. So it does show that it does exactly what it's supposed to. And having that in your portfolio is a great way of offsetting any losses that you may make across the board. Now, that's not to say it'll offset all of your losses because there'll be some stocks that fall a lot harder. But
I guess it just depends how much you buy.
Exactly. So in terms of going forward, I think that, depending on your level of experience, this is a good stock to have ready to implement when you can see that, the market might be turning. I personally wouldn't have it sitting in my portfolio all the time. It would be something that I would deploy as I think that the market might be on a trend down. I'm not going to be buying this to sit in my portfolio for 2 or 3 days, but if we're trending over 2 or 3 months that it's going to be going down, and that obviously is hard to predict, but that's something that I would look at having in my portfolio. So
yeah, I mean, look, a lot of people used to do this with gold. So what they would do is, they'd have their portfolio and then they would buy gold because gold is a counter-cyclical asset. So what that means is when the market's going up, gold price is generally not doing that well. But then when the market falls, a lot of people take their money out of shares and put it into a safe haven that's gold, and gold prices go up. So people, protect their investments by having a bit of gold in their portfolio. These days, because of ETFs like this, you can more accurately protect your portfolio, I guess. You can buy something that is going to be counter-cyclical because it is, directly negatively correlated to the market. Some people would buy it for safety. Some people would be really strategic with it. If they reckon the market's really, really getting to the top of its cycle,
they'd be going hard.
They would load up. They would start selling their shares where they've made a lot of money as the market rises, putting it into something like Bear. And then as the market tanks, Bear then gives them, because Bear goes up in price, when the market bottoms out, they can sell that and they can buy a whole bunch of shares and then ride the crescendo of the market once again. It's obviously really nice in theory. It's really hard to time the market that well.
Yes.
But, it's a strategy that, some people try to do, some people do quite well. It's definitely worth thinking about, and definitely worth knowing about.
Yeah, it doesn't have to be 20% of your portfolio or 30% of your portfolio. It could even be as small as 5%, or you might even just decide to have a little bit in there just to see how it moves. But we're going to chuck it in to our portfolio online because both of us are feeling a bit bearish at the moment.
Yeah, and, it's a good learning experience to sort of see how it operates in the portfolio.
Yeah.
Everything else in our portfolios has gone up so far, so we're kind of made it so not everything can all be in positives, because if the rest of our stocks all go up, chances are Bear will go down and vice versa. So farewell all greens, but hopefully more consistent longer term returns as a result. That's right.
Yeah. And look, if our attitude changes towards the market over time, then we'll make a decision accordingly to whether or not we keep this in our portfolio or not. But both of us just found this was an interesting stock and a great way to get access to shorting the market as such without actually having to go ahead and do it all yourself. So that's our stock of the week. We'll be throwing $1,000 towards it with our new broker, IG.
Yeah, first buy with the new broker and hopefully future sponsors. So IG, if you're out there, give us a call.
That's it. That brings us to the end of episode 11. Some great stuff in there. I really enjoyed the book review. There's some great lessons. And as we mentioned, Ren will throw up your review of that on the website when the podcast goes live this Sunday. We have got some feedback during the week about our news episodes. So we're going to also keep you guys updated about actually where we're getting our news from, and we'll chuck that up online as well. We might even do it through Facebook, but we'll start online on our website, equitymates.com, so that you guys can do a bit more research about what we're talking about going forward.
It's probably worth saying. It's probably worth saying as well. On our Facebook page, we share news that interests us. So if people are wondering where we get our news, our Facebook page will be a good starting point for you guys to sort of read some of the same articles that we're reading.
Yeah, it's because we read this stuff every day, so we love it. Thanks for listening, and keep the feedback coming in. We really appreciate it. It's our best way of improving with you guys. You can contact us via email, equitymates@gmail.com, or through our website or Facebook page. But until next time, we've got an expert investor lined up for our next episode. Keep posted, keep listening, subscribe and rate us, and we'll talk to you next time.
There you go. Pretty off.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.